Next up are MacFarland and Amanda Han. And thank you, Karin, by the way. Matt has over 20 years of experience in public accounting as a CPA and tax strategist. He has worked for both the Big Four and regional CPA firms. Amanda has over 20 years of experience as a CPA with special emphasis in real estate, self-directed investing, and individual tax planning. You can catch their best-selling books, Tax Strategies for Savvy Real Estate Investors, and the book on advanced tax strategies, Cracking the Code for Savvy Real Estate Investors, on Amazon.
Great. Thank you so much, Bruce, and thank you, Norris Group and Aaron, for putting on this great event. We've, again, been doing this for, I don't know, we lose track, right?
11 years.
11 years? Is that the number we settled on? So it's great to be back. It is, the title of our presentation is apropos. It's tax planning in uncertain times. It's no joke that, we mentioned earlier that the presentation is changing every day, right? I think we changed our presentation like 2 days ago because of what came out again with the talks and everything like that. So
yeah, let's go over the agenda for today real briefly. So we're going to touch on what the latest and greatest information we have on the proposed tax changes. Like Matt said, it is changing by the day, by the minute. And thank you to our video and IT team here for helping us make those last minute changes as late as this morning. We're going to talk about some 2021 year-end tax planning considerations. Specifically, what are some of the things we should be doing or thinking about doing in the midst of unknowns, if you will.
we also want to talk about how you can prepare for increasing IRS audits, and we're going to talk about why that might be coming down the pipeline.
Yeah, and of course, our favorite part, I think Aaron mentioned earlier, we'll have plenty of time today for Q&A. And just like the other speakers, we're super happy to be here with, a lot of the greatest minds in real estate and in legal and self-directed and 1031 exchange. So definitely jot down your questions if you have any as we go through the presentation. We'll have plenty of time for that later on today.
So the first thing we want to show you is this came out from Accounting Today. It's a publication in the accounting industry. This came out about a month ago when the House Ways and Means Committee first brought up their proposal, or President Biden's proposal. And they were talking about the biggest tax increase in a generation is coming down the pipeline, where they're looking at $2.1 trillion in new tax levies. Now, as a result of the changes a couple days ago, that number has dropped down to 1.75, 1.5 trillion, something like that, right? But it's interesting to note that they are noting that it's going to be one of the biggest changes in a long time, which is funny to us because when the Tax Cut and Jobs Act came out like 4 years ago, we thought that was one of the biggest things that came out in the last 20 years. Then we had the CARES Act last year. So it seems to be just recurring changes every year. But so keep that in mind, that they're talking about the biggest tax increase in a generation, right? But on the same token, President Biden and his proposal has come out and said that he's got some clear delineation line of, for those people making less than $400,000, he's saying there's not going to be any new taxes or no new tax increases for those people. So again, that's an important number, distinction number to keep in mind with respect to potential tax changes.
So earlier, when Karin did her presentation, she mentioned there were a lot of, originally proposed changes. A lot of those seem to have gone to the wayside. So let's look at how those impact the income tax side of it. And we'll touch on those again. You'll see these are changing by the minute. So originally, within the proposal, we were looking at top tax bracket increases for wealthy individuals to 39.6%. And the definition of wealthy. Do you want to talk about that?
Yeah, I mean, that's the funny thing, right? Is that you may be out there, you might have just found out that you're a wealthy person now. So they are again, that $400,000 mark is kind of where they are defining people as wealthy people now.
Yeah, what's interesting is in the original proposal, $400,000 single. And for married individuals, it's $450,000. So not $800 for married; it's only $450, which is a pretty significant marriage penalty, if you will. The good news, I guess, so far is that it looks like this proposal is not currently in the tax framework in the Build Back Better plan.
Say that fast, right?
And so we have optimistically crossed it off
Yes.
on our PowerPoint presentation. Just the caveat, we're not seeing that currently in the proposal, which is really great news, something that they kind of hopefully have abandoned. Nonetheless, it certainly, any of these certainly could come back because we're still far from a final proposal and then,
Right.
signatures at this point in time.
Along those same lines, one of the big changes that we were really concerned about as real estate investors, tax planners, was they were talking about raising the top capital gains tax rate from 20 to 25%, again, for people who are, quote unquote, wealthy. And this was actually going to be retroactive back to sales that happened after September 13th, which was, I guess, the date of the original proposal. So good news, it wasn't in the proposal 2 days ago. So hopefully that's off the table. But again, could come back, I guess, right? But so as of right now, we're looking at, no increases in personal tax rates and no increase in capital gains taxes, but we'll see, I guess.
Yeah. So another one that we've crossed off optimistically.
C Corp tax changes. Right now, the tax is 21%. It's a flat tax. They were looking at actually making a graduated tax at 18, 21.5, 26, making it all changes. So right now, it looks like they're taking that off the table for the most part. So you're looking at, C corporations having a flat tax of 21% going forward as well. And then the other one is QBI deduction. So for those of you who don't know, back when the Tax Cut and Jobs Act came out at the end of 17, they brought forth this new deduction called qualified business income deduction. Essentially, it was a way for you to have 20% of your business income be tax-free. So essentially getting a deduction for 20% of your income, so you're not paying taxes on 20% of your business income.
Yeah, so in a very simplistic example, if you're a real estate or a real estate agent or broker, you made $100 of taxable income, maybe $20 of that would have been tax-free, and you pay taxes on the remaining 80, right?
Right. So the original proposal about a month ago, they were looking at putting a cap on the overall deduction, meaning you couldn't get more than X dollar amount of tax-free income from the QBI deduction, or maybe limiting some of the phase-outs or some of the industries that it would apply to. But I guess the good news is, again, this didn't make the proposal as of a couple days ago, so hopefully that's going to be left alone.
Like Karen mentioned earlier, lots of proposed changes to retirement accounts in terms of, our ability to have tax-free money via Roth conversions, or even, for real estate investors, something that, we all hold near and dear to our heart is our ability to use retirement money into self-directed real estate deals such as syndications, private equity investments, effectively investments that require the investor to be an accredited investor. This was really an interesting thing that I saw. I think a lot of people in the real estate industry really banded together, from CPAs to sponsors to self-directed custodians and tax attorneys, and everybody really got together and lobbied their congressman. And so again, the great news here, it looks like those proposed changes are now off the table. So we'll put a interim victory to cross that one off as well for now.
All right, so these are some of the things that we think are gone from the proposal. Again, they may come back, but good sign that they weren't in there a couple days ago. So let's go over a couple of things that are probably still there based on what we've seen. One of the things they're still talking about is an additional 3.8% tax on ordinary business income. So for those of you who may not remember, if you think back 10, 11 years with President Obama, he came out with what, affectionately known as Obamacare. And part of that was a 3.8% net investment income tax to help pay for Social Security and Medicare. But it was on an investment income at that point, and it still has been all these years.
Yeah, so typically investment income, capital gains capital gains, interest, dividends. So for higher income individuals, for the past several years, we've had to pay this additional 3.8% tax on top of federal and state income taxes.
So what the proposed changes they want to do is implement this tax on ordinary trade or business income that you aren't, so basically income from profit from an S corp, profit from a partnership, income that you're not already paying Social Security and Medicare taxes on. Now, this again would only apply to people making $400,000 or more. It's 400 for a single. I think it's 500,000 for a married couple, if I remember correctly.
So this is very impactful for, I think, a lot of investors, with active income. For example, you might be operating your business in an S corporation as a realtor or broker or someone doing fix and flips, wholesale, that type of.
I'd be running a CPA practice in an S corp. You never
Running
know.
a CPA practice, yeah. So under current law, your income, your K1 income from those types of entities, you do not have to pay this 3.8% tax on. Okay, that is currently only for investment income, but the proposal is to now also include this additional tax on flow through income as well. So again, it's on top of federal and state income taxes. So this is a potentially very harmful one in terms of active income for flow through entities. And earlier in the slide we talked about how there was an initial proposal to increase C corp tax rates, but that seems to be gone. And so if that is gone, I think for a lot of investors or taxpayers in general, we might want to consider, or at least work with your tax person to consider doing an analysis and figuring out whether your LLC or S corporation is still the most ideal entity structuring, or if you might save more taxes going forward as a C corporation. But there's a lot of different nuances involved in terms of other benefits of being a flow through. So definitely a decision.
Definitely not a do-it-yourself thing. So have start those lines of communication, get those lines of communication open with your team of advisors. So another one that looks like it's still on the table, one of the proposals is related to the excess business loss. Now, try and keep this simple. This, again, was one of the things that came out with the Tax Cut and Jobs Act. They have for a few years, they had put a limit on how much net business losses you could use to deduct against other sources of income like wages, investment income. So what the proposal is saying, that was supposed to sunset at the end of 2025, like go away. But this proposal is going to make it permanent, where the most net business loss you could deduct against other sources of income would be a max of $500,000 per year. So what does that mean? That's if you're a real estate professional and you invested a lot of rental properties, you did cost segregation, generated a lot of depreciation, and your net overall losses from your rental properties was $600,000. Even as a real estate professional, the most you'd be able to deduct against your other sources of income in that example would be $500,000. And this is a overall limit. So it's not $500,000 kind of per line of business, because we get that question a lot. So you could have all your rentals, you could have an S corp that generated a loss for some reason. You have to combine all of your quote unquote business income together to apply that limitation.
Yeah, this is potentially very detrimental for individuals who maybe are real estate professional with a lot of W-2 income. But if you're maybe a real estate professional with a lot of other business income, let's say an S corporation where you're a physician or an attorney or something like that, or a flipper, then this limitation might not be as impactful because like Matt said, it's based on net business losses. So just one clarification: the excess business loss limitation is the current law, so it's not a brand new thing that's coming up. The proposed change is to just make it a permanent law instead of to sunset as the original plan was to do. Okay.
So another thing we talked earlier about, they were looking at changing C corporation tax rates, making it kind of a graduated scale. They look like they're doing away with that. But on the big picture scale, and this may not apply to a lot of people obviously, but on a big picture scale, they're looking at applying a minimum tax of 15% on certain C corps that make over, I think the threshold was like $1 billion of book income, actually.
So probably not a lot of our participants here with us today.
Maybe George, but I don't know.
Or Bruce, yeah. But so if you have a C corp that's under that dollar amount, we're not really super concerned, but thought we would still throw that out there, because sometimes when the corporation taxes are increased, even though it's on the much larger corporations, sometimes those costs are passed down to us as everyday consumers. So not so much a direct hit to our wallet in terms of what are some things we can do as investors. It's not going to have a direct impact on us. Nonetheless, something good to know because it does impact a lot of the larger corporations.
So along those same lines, I know one of the original proposals, and I think there was a lot of pushback, with Congress and all the people, was they were going to put a billionaires tax out there, right? So they've kind of curtailed that one, but in place, it looks like they've put in this proposal for a 5% surtax on people earning over $10 million, and those people who actually earn over $25 million, you pay an additional 3% on top of that. So if you happen to be somebody making $25 million a year, congratulations. But you're looking at, obviously a highest federal tax rate of 37%, looking at 3.8%, probably net investment income tax. You got another 8% here.
And that's on top of federal income taxes and state income taxes.
Right. So people are going to start moving to foreign countries, I'm guessing, right?
Well, so as of this morning, the latest and greatest is now they've reached some kind of consensus, right, on having a global minimum tax. So
Yeah,
you're gonna have to move to Mars, I guess.
So it looks like Aaron's screwed. He's going to be paying an extra 50% on his income.
All
Okay.
right, so let's go to good news.
Good
because
news.
We love sharing good news. And actually, I feel like everything we've talked about so far, minus the last slide, were a lot of good news, right? Because if you guys, any of you joined us last year, I think we had just a slew of bad news on proposed changes.
We forgot to tell the caveat of don't shoot the messenger, right?
Yeah. But, I mean, really, in I think our first two slides, we were talking about, how bad things could have been, but a lot of those are off the table now. So let's talk about good news. This is on state and local taxes for those of you joining us from California or just other high income tax paying states like New York. Currently, there is a limitation. So in terms of state income taxes, property taxes, we can only write off up to $10,000 against federal income tax. There is no official information in the proposal to repeal this. However,
There's been some very vocal congressmen saying that it's going to be added back.
it will be added in the final one before they anything is signed. And so basically, this is a repeal of the $10,000 cap. In other words, they're looking to get rid of that. So meaning if you're paying between property taxes and state income taxes, $30,000, we might again be able to write those off without just limiting it to $10,000.
Now, the interesting thing here is they're looking at repealing it only for 2022 and 2023. It's kind of a, we'll give you a little bit here or something like that, right? And then I guess bring it back in 2024.
Yeah. This is, it's really interesting. I think it's just for budgetary purposes. They want to give us the benefit, but, don't really have in the budget to give it to us forever. So they said, we'll give it to you for 2 years and then, bring it back. Or maybe by then there'll be other votes to kind of see what happens. One quick tip in terms of year end, right? Because now we're looking at year end tax planning. If this were to pass or you think is going to pass, it could make sense to try to delay the payment of your primary home property taxes or your state income taxes into January of next year.
Some people may owe fourth quarter estimated tax payments come January 15th. Based on this, probably makes sense to wait to pay that till at least January 1st.
Yeah, and the reason being, you might be able to deduct it next year versus this year, it's almost a certainty that we would be capped at just $10,000. Okay.
1031 exchanges. Dino's here. She's going to talk about that, but there's some good news there that we think they're, hopefully not going to touch it, but we'll let Dino elaborate on that a little bit more.
Yeah, what was interesting, I think, so the other is step-up basis, and one of the original proposals was that we would no longer get step-up basis, which means when a taxpayer passes away and their beneficiaries inherit the asset, and then eventually when they sell that, they would have to pay taxes on the appreciation, right, that was incurred for the property throughout the duration of ownership. This looks like it has gone away, and so if you look at, one of the, kind of long-standing strategies for real estate investors is to buy real estate, take all the benefits of the real estate deduction over the lifetime of ownership, do a 1031 exchange when you sell into larger properties, and then essentially leave it to your heirs with step-up basis whereby no one is really paying taxes. So, at least for now, it sounds like that would still be a valid strategy for a lot of taxpayers.
Also, bonus depreciation. That was a big one. There was a lot of talk because leading up to the election last year, under the proposals, they were talking about taking away, unequal and unproductive tax benefits for investors. So they never mentioned bonus depreciation specifically, but we were all worried that was going to be one on the table. So far, it's not on the table. So right now for 2021, 2022, you can still take 100% bonus depreciation. And then that drops down by 20% each year thereafter until it phases out under the current law.
Yeah. So, I think, again, overall, the view, I think, for us is very optimistic. We're in a much better place today than we were maybe even a couple weeks ago in terms of what the proposals are. Really important to just make sure you're working with your tax advisor between now and the end of the year. What we're always telling people is, don't panic, but plan. right? Don't panic. We don't really know what the final will be, but plan or be ready to plan when things are changing. So we put together on the slide a couple of things to consider before the end of the year.
Right.
And again, you guys we'll have plenty of time for Q&A. But if you don't think taxes are going up, okay, here are the strategies that you should be looking at.
So a lot of these are a lot of the traditional strategies we've talked about for years, right? You're looking at, deferring income, prepaying expenses, maximize your deductions through depreciation or retirement account contributions. Look at harvesting losses through capital losses, or maybe you got passive losses for properties that you might want to look at selling so you can trigger those losses. Things of that nature to look at if you don't think taxes are going to go up.
Yeah. And if you're someone who feels like your taxes are going up, right? Because again, there are income thresholds in terms of whose taxes are going up and whose are staying. So this is also specific to your particular tax rate and also what your expectation or you and your CPA's expectations are. But if you are someone who does think taxes are going up, then we're kind of considering the alternative, right? Which is accelerating income to this year before the end of the year, including capital gains as well, right? Sell real estate before year end. Defer paying expenses. We talked earlier about the state income taxes, right, or property taxes. If we think that the limitation will be going away next year, we want to defer payment of those. Maybe we want to elect out of bonus depreciation because we want to keep more traditional depreciation in future years.
Yeah, I think a lot of people don't realize that you can elect out of bonus depreciation. So you don't have to, if you have 5-year assets, you could take 100%. You don't have to. You can spread it out over 5 years. And sometimes that makes sense for certain taxpayers.
Yeah. And then Roth conversions, obviously, that's a big one too. If your expectation is that your taxes will be going up in the near future, then now might be the time to consider converting some of those assets to Roth so that it's growing in a truly tax-free environment going forward. Right?
Now, we mentioned earlier, one of the other things to think about today was potentially preparing for increase in IRS audits. And the reason being is that in the proposals, in the original proposal, what they talked about a year ago, proposal a month ago, still in there 2 days ago, is that they're setting aside probably $80 billion to give to the IRS to improve their enforcement, improve their computers, improve their, lack of better testing, tracing, whatever you want to call it.
Yeah.
So it looks like this is coming down the pipeline is because the way they look at it is it's a low-hanging fruit where if they can audit and generate revenue, this is an easier way to do it. What's the word politically, so people they don't have to go out and say that they've raised tax rates. They're just going out and collecting more money through audits.
Yeah, what's interesting is I was reading, so in the billions of dollars going in, the expectation is that's going to raise $400 billion of revenue and more. And there are other studies who are saying you might only raise $200 million. Nonetheless, what's really important for taxpayers to understand, and again, this is not new. In our legal system, most people, if there's a crime that occurred, you're innocent until proven guilty. That's not how it works when it comes to taxes. When it comes to taxes, you are guilty until proven innocent. And what I mean by that is whatever position you're taking, whether it's writing off expenses or if claiming real estate professional status or a transaction between corporations that you own, you have to be able to prove those. You have to be able to prove those actually occurred, because if you cannot, then it is likely that you might lose on a potential audit. Now, it doesn't mean we should abandon all our strategies. It simply means that you want to be more proactive and even spend more time to ensure that your documents are in place, because the way that it happens is, you're not going to be filed, you're generally not going to be audited immediately on a return you just filed. So when someone is audited, it's usually going to be a couple years from now. And if you're like Matt and I, we hardly remember what we did last week. And so if you think you're going to remember 3 years from now what you did on a particular expense or particular property, better make sure you have those documentations to at least jog your own memories.
Right. So if you find yourself in a position where you're always asking the question, like, well, how are they going to prove that? Well, you've got it all wrong, right? You're the one who has to prove it. So just keep that in mind. As Amanda mentioned, get your documents in row now. Get everything lined up so that it makes the process easier if you were to get audited down the road. So what's next? It's just, it is time to plan. As we mentioned earlier, open those lines of communications with your team of advisors. Time to prepare. Don't panic. Make some educated decisions based on what you think is going to happen in your situation. And, just don't sit back and wait. That's probably the best advice we can give you.
All right. Thank you guys so much.